Whoa, the new Fed chair has already plans how to crush the prices of gold and silver, starting day one as the new Fed chair. Absolutely hilarious. Pay very close attention. So Kevin Walsh, at the first day, he will be start something very interesting known as quantitative tightening. Essentially would mean that the demand for gold and silver as precious metals hedged against the market would drop significantly. Look at this. First of all, the FOMC statement and press conference post confirmation most likely will show the increase of Treasury rolls, which means that they will leave most of the bonds to mature, which would drain out the liquidity of the market. It's absolutely unbelievable. Pay very close attention. The current $25 billion per month will go to $40 and $50 billion per month, which essentially will restore the balance sheet and will normalize the market. Why this will do? Well, this will essentially craft the lower inflation, something that Kevin Walsh is focusing, because regardless of what the inflation CPI data is reported, we know the actual reinflation is always higher than the CPI numbers. Also, without cutting rates aggressively, this is opposite of what we all expected, because Donald Trump wants the rates to be cut even lower and lower. But the problem over here is that he was part of the recovery of the market in 08-09 financial crisis. So this is not his first rodeo. He's pretty much aware how Wall Street thinks, how Wall Street speculates, so he knows how to play the markets. And also he's a big fan of having a strong dollar, which I am fan as well. So here's what's going to happen after he steps in. This move from increasing the balance sheet to $40 to $50 billion per month will effectively drain the excess reserves, and this will happen sharply. This will not have couple of different weeks that let people to adaptate to the market. No adaptation. Everything will happen sharp and fast. This will trigger short-term rates will also go higher. This will make yield curve to flick a little. And we all know all these big macro economists, all these analytical firms, they're always watching and paying attention to the yield curve. And when they see the yield curve, which effectively showing you the interest of long-term bonds versus short-term bonds, which effectively showing you how the Fed thinks that the economy will perform in the long-term and short-term debt cycle. So how good or how bad the economy will be today versus the next 5 years, or 10 years, or 3 years, right? So this is giving you perspective that the Fed is preparing for either recession or stagflation or some different economic turnover. Pay very close attention. So this particular moves, steeping the yield curve, right, will make the dollar super strong. Second, the global investors, will go after the US yields. They're gonna start buying treasuries again, because you buy government paper pays well, good yields. Also, the gold and silver demand will collapse. And this is economic principle. We're not here, trying to speculate. This is not, some Marvel movie. This is like plain and simple formula, where from one side, when you increase the yields, when you increase the demand for US treasuries, when you increase the yield on the US treasury, when you increase the demand for US treasuries, the gold and silver fall apart. There's no demand. Why would you be spending X amount of money for volatility when you can get it, just holding securely US treasuries, right? It's crazy. Also, after the gold and silver demand collapses alongside with the prices, of course, there will be something known as opportunity cost for people who are holding it. Why is that? Because the real yields will spike to around 50 to 100 basis points, which will prompt a lot of the funds to dump non-yielding metals, like I just explained it briefly. At the end of the day, it's all about bucks. It's all about the return on your investment. So if your investment yields less holding it here instead of here, of course you're gonna dump this one. And I've said in other videos, right? If you're emotionally attached to your investment, you most likely going to lose, because this doesn't allow you to think clearly about the market. It's like people who are holding something for many, many, many years, and they're holding it because they like it. in the day when they decided to sell it might be the day when the prices are the lowest. And like I said, they weren't aware why they bought it, they're not aware why they're selling it. It's very likely that you bought something on top and selling it at the bottom. This is how most people lose money on the markets. Moving forward, markets, after Kevin Warsh steps in and executes on this plan, markets will react very, very fast. They're not going to be waiting. In just a couple of days, you will see the dollar index, DXY, will explode 2 to 4%, which effectively means that it will be very good because then the Treasury could print even more government paper. Remember, they were voted last year to remove the debt ceiling. This year, if they print so much Treasuries, if they issue so much, if they sell so much on the auction, they could, pay off probably a third of the debt if the dollar is super strong, if the yields are good, if there is a huge demand again for US Treasuries bonds, right? This is very, very important. And this is if you really think about this, is in pure interest of the US and the US economy. It's not, taking care of individual investors or the Wall Street. If you really care about Wall Street, you're gonna be leaving the market as it is. You're gonna leave the market to ride the speculation of gold and silver, copper, palladium. But if you really care about the US economy, you would take care first of US debt. You're gonna take a very good care of the inflation. You're gonna take a very good care of the jobs. You're gonna take a very good care of the value of the national debt issuance, right? You're gonna take a very good care of the Treasury, and you wanna make sure that everyone's getting paid in the government, right? Because they're always short on payroll. You always, every single year, you will see the Congress has to vote to remove the debt ceiling limit, right? So they can print even more, so they can sell even more, so they can raise more funds, so they'll be able to make payroll. But if this actually happens, remember, the dollar, last time the dollar was very, very strong was throughout the last term of Donald Trump. I think it was the end of the first or second year of his term. And when the dollar is super strong, US again will gain edge over Europe, European Union, and Euro. This is very important. Remember, dollar has to be number one, should remain number one, not precious metals, even not above Bitcoin or whatsoever, right? Because the dollar is the basis, is the foundation.